Imagine finding out that the multi-billion-dollar tech giant that builds the software running your local coffee shop and probably the financial app sitting on your phone right now
Yeah.
has just completely abandoned the concept of building apps.
Right, yeah. Which is a wild thing to hear.
I mean, that's exactly what the leadership at the maker of Square and Cash App just told Wall Street.
It's just a total paradigm shift. I mean, they are publicly declaring that the whole era of sweating over pixel placement, navigation menus, waiting for users to click a button, that's just over.
Welcome back to The Learner. You've asked us for a custom-tailored deep dive, and today our mission is to decode a massive underlying shift happening right now in the fintech world.
Yeah, and we are unpacking transcripts from a recent financial Q&A session where this company's founders and top executives fielded questions from analysts.
And what we found isn't just a dry review of quarterly earnings. We're looking at a literal blueprint for how a company is fundamentally rewiring itself from a traditional software developer into, well, what they're calling an intelligence company.
The context here is just explosive growth. We're talking about a first quarter where Cash App borrow originations are up an incredible 82%.
Wow, 82.
Yeah, 82%. Primary banking actives are up 18%. And they confidently raised their full-year outlook to 19% gross profit growth.
That's massive.
It is, with 27% adjusted operating margins on top of that.
Okay, so those are undeniable numbers, but the numbers are really just the exhaust fumes here. The real story is the engine.
Right.
You don't get that kind of acceleration in a mature fintech market by just, tweaking a marketing budget.
Yeah.
You have to fundamentally change how the company operates from the ground up, which is exactly what they did.
Yeah, they recently underwent a massive internal restructuring and tear down their existing hierarchy.
Right, to create a much flatter organization.
They absolutely gutted the traditional corporate structure. I mean, the strategy involved moving away from massive siloed departments and instead creating incredibly small, highly focused teams.
And they pushed decision-making power down.
Right. Exactly. Down to what they call directly responsible individuals, or DRIs.
Okay, let's unpack this for a second because my radar always goes off when I read transcripts like this.
Oh, for sure.
Whenever a massive publicly traded tech company says they are flattening the org and reducing red tape, it usually just translates to massive layoffs.
Right. Cost cutting.
Yeah, cost cutting, throwing a bone to Wall Street to boost the stock price. But in these Q&A sessions, leadership is actively claiming this is a product velocity strategy.
Which is a bold claim.
Very bold. It sounds like they aren't just trimming the fat. They are trying to swap out the entire engine while the car is driving down the highway at 80 miles an hour.
Yeah.
Are we really supposed to believe that removing a few layers of middle management suddenly makes an engineering team build revolutionary products faster?
I mean, it's a completely justified skepticism. Cost-cutting disguised as innovation is, the oldest trick in the corporate playbook.
Exactly.
But the data they presented actually isolates the velocity metric. They aren't just relying on smaller teams to move faster.
What are they doing then?
They are combining that newfound human autonomy with a massive foundational AI harness they internally call Goose.
Goose, right. And the speed metric here is what really caught my eye in the source material.
It's wild.
They are claiming that production code changes per engineer are up more than 2.5 times since the start of the year.
Yeah.
A 2.5x increase in shipped code per person isn't something you achieve just because you fired someone's boss and cancel a weekly status meeting.
Exactly the opposite, actually. The friction in software development isn't usually the complex problem-solving part.
Right, it's the tedious stuff.
Exactly. It's the boilerplate code, the testing protocols, the integration hurdles, and Goose is designed to automate those mundane foundational coding tasks.
So a directly responsible individual isn't spending 3 days writing the framework for a new feature.
Right. Goose handles a framework in seconds, and then the human engineer spends their time entirely on creative problem solving and rapid deployment.
So if an engineer is suddenly writing 2.5 times more code, the immediate question is, well, what exactly are they building with all that extra bandwidth?
That's the real question.
And the answer seems to be a complete identity shift away from static software. They want to deliver proactive intelligence.
Yes.
And they highlighted 3 specific tools built on top of that Goose foundation to do it. First up is BuilderBot, which, it sounds like something out of a sci-fi novel.
It really does.
It allows their internal employees to use a simple Slack message to build or fix a feature in the live code.
And the vision for BuilderBot extends way beyond just internal engineering. They eventually want sellers, the local boutique owners, the food truck operators, to use this technology to custom build their own interface features on the fly.
Think about the implications of that for a second. The platform's product roadmap is no longer the bottleneck for a merchant.
Right.
If a coffee shop owner wants a highly specific loyalty tracking feature on their point-of-sale system, they don't have to submit a feature request and wait 2 years.
No, they just ask the AI to build it for their specific terminal.
That democratizes software engineering for small business owners in a huge way.
It totally does. But it gets even more sophisticated when we look at ManagerBot, which they've already rolled out to over 1 million sellers.
1 million, that's a huge test group.
Massive.
Yeah.
And leadership describes it as a COO in your pocket. But more importantly, they call it a protector.
And from what I read, ManagerBot isn't just a basic conversational chatbot slapped onto a database.
Oh, not at all.
It utilizes over 100 local AI agents running simultaneously. So it's not one giant monolithic brain. It's more like a digital trading floor.
Oh, that's a great way to put it.
You have one micro agent doing nothing but analyzing the weather forecast for next week, right?
Yeah.
And it's yelling across the digital room to another agent that manages the cold brew cup inventory.
Yeah.
While a third agent is analyzing employee sales performance to figure out who your top closer is.
That is a perfect visualization of how agentic AI architecture actually functions. It's a swarm of specialized intelligences. And because these agents are constantly running in the background, absorbing all that menial cognitive load of running a business, leadership noted it is already driving surprisingly high retention among sellers.
Then you have the consumer side of the equation with MoneyBot, which hit 1 million active users without a single dollar spent on marketing.
That's just wild to me. Zero marketing spend.
Yeah, zero. And this is where the concept of proactive intelligence really clicked for me.
How so?
Well, instead of making a user open the app, stare at their balance, look at their upcoming calendar, and do mental math in their head, MoneyBot does the heavy lifting.
Right, it anticipates.
Exactly. It sends a push notification proactively alerting the customer to a potential cash flow deficit that might happen next Thursday.
And to fully grasp how aggressively they are deploying this AI-driven development, we have to look at the ultimate example they provided to the analysts.
Oh, the buy now, pay later thing?
Yes. They tasked 2 machine learning engineers who had absolutely zero prior exposure to the specific financial services they were working on to build and ship a buy now, pay later feature for Cash App Pay.
I saw that in the notes. The timeline on that project was 3 to 4 weeks.
Yep.
Inclusive of all quality assurance and testing. And the original scope for that exact same project required 5 to 6 engineers working for 3 full months.
It's just an exponential leap in productivity. And it's entirely because the Goose AI harness was able to guide those 2 engineers through an unfamiliar code base.
Just suggesting the right implementations and catching errors in real time.
Exactly.
Here's where it gets really interesting, though. They talked about this overarching future vision called agentic commerce, where an AI agent could eventually be authorized to automatically purchase inventory from vendors based on those demand trends we talked about.
Right.
Now, hold on. If I'm a small business owner fighting for every single dollar of margin, am I really going to hand over my company credit card to a bot and let it buy supplies on its own?
Leadership is actually acutely aware of that psychological hurdle. You don't just flip a switch and ask a human to trust an algorithm with their capital.
Obviously not.
This is why they keep using the word protector when describing ManagerBot. The transition to agentic commerce is fundamentally about building a ladder of trust.
So they have to prove themselves on the small, low-stakes stuff first.
Exactly. The AI has to demonstrate deep, undeniable competence before it ever gets purchasing power.
Right.
It starts by correctly identifying a trend. The human missed like noticing espresso bean usage spikes, specifically when the local high school has early dismissal.
Oh, that's incredibly specific.
Yeah, and then it accurately projects that based on next week's schedule, the shop will need 20% more beans.
Okay, I see.
Once the AI consistently proves it understands the microscopic rhythms of the business better than the owner does, the psychological leap to letting it automatically execute the reorder from the vendor becomes much, much smaller.
Okay, so on the seller side, the AI is predicting inventory needs. But let's look back at the consumer side with MoneyBot.
Yeah.
We've seen how the AI can proactively alert a user to a personal cash flow deficit. It taps you on the shoulder and says, hey, rent is due in 5 days, and based on your daily spending velocity, you're going to be $50 short.
Right.
Naturally, The very next step in a closed financial ecosystem is offering the immediate solution to the deficit they just pointed out. Which brings us to the company's massive profit engine.
Cash App Borrow.
Exactly.
And this is where the quarterly financials from the Q&A really flex their muscle. As we mentioned, Borrow originations were up an astounding 82%.
And it's not just the core Borrow product seeing that kind of acceleration.
Yeah.
They noted that every single new lending product they release, like the Afterpay post-purchase feature
Yeah.
and their brand new pre-purchase feature, is growing faster than the previous one did at the exact same stage in its life cycle.
Yeah, it's clear evidence of the compounding power of their underwriting models.
And they are also optimizing the back-end mechanics of how these loans are funded.
Yeah.
Right? They moved origination over to their internal bank, SFS.
Let's clarify why that matters, actually, because internal bank just sounds like corporate restructuring jargon.
Right.
By using SFS, they completely cut out the third-party sponsor banks. They stopped paying a middleman for the cost of capital.
Oh, wow.
Yeah, and that massive improvement in unit economics and margin is exactly what allows them to confidently expand lending eligibility into new states.
And unlock higher borrowing limits for verified users in their Cash App Green tier.
Exactly. It gives them total control over the financial stack, from the consumer interface all the way down to the regulatory capital requirements.
But I have to push back here, and push back hard.
Let's hear it.
We're talking about an 82% jump in short-term unsecured loans and buy now, pay later capabilities.
Right.
This is largely targeting an audience that historically might have been overlooked, underserved, or deemed too risky by traditional legacy banks.
Yeah, absolutely.
My immediate thought is, isn't this a massive subprime bubble waiting to burst?
Yeah.
How are they scaling unsecured lending that aggressively without taking on absolutely toxic levels of risk?
Well, a traditional bank would absolutely be taking on toxic risk to grow that fast.
Because they just look at a FICO score.
Exactly. A traditional bank underwrites risk by looking at a static snapshot, a credit score from a bureau, a stated income, maybe a W-2.
Right.
The genius of this company's closed-loop ecosystem is that it doesn't look at a snapshot. It watches the entire motion picture.
Meaning they have access to data points a traditional bank couldn't even dream of.
Precisely. They see the exact inflows of direct deposits coming into the app. They see the real-time outflows of what the user is buying at Square merchants.
Yeah.
But more importantly, their underwriting model dynamically learns from peer-to-peer data.
Okay, explain that peer-to-peer mechanism, because that seems like the secret sauce.
Mhm.
How does who I send money to impact my risk profile?
Think about the network effects of financial behavior. If you are consistently sending money to or receiving money from peers who have excellent repayment histories, high balances, and stable direct deposits.
The AI connects the dots.
Exactly. The AI infers you are embedded in a financially stable network. It maps your financial social graph.
That's fascinating.
And that mathematically lowers your perceived risk profile before you even apply for a loan, allowing them to underwrite you with a higher degree of confidence than a FICO score ever could.
Okay, I see how a closed loop offers an informational advantage. But a 3.16% loss rate on unsecured loans to this demographic still sounds incredibly fragile to macroeconomic shifts.
Sure.
I mean, if inflation spikes or a recession hits, a closed-loop ecosystem won't magically put money back in a user's wallet. If the user loses their job, they default, regardless of how good the AI's social graph mapping is.
Macro factors are an unavoidable risk in lending, yes. But the transcripts show leadership defending against that argument by pointing to the maturation of their user cohorts. The AI isn't just predicting risk at the moment of the first loan. It is constantly recalculating as the user's tenure on the platform increases.
Right. They laid out very specific loss rate numbers based on how long a customer has been in the ecosystem.
Yeah, for their newest customers, which is the highest risk group because there's the least amount of behavioral data, the risk loss rate sits at about 3.16%.
Okay.
But look at what happens over time as the AI gathers more data on their habits. For customers who have been on the platform for 7 to 12 months, that loss rate drops to 3.01%.
That's a noticeable drop.
And for their most established customers, the ones who have been actively transacting in the ecosystem for 13 months or more, the risk loss rate drops down to a highly manageable 2.67%.
So the longer a customer lives inside the ecosystem, the more predictable their cash flow behavior becomes, and the safer a bet they are. The AI isn't just making it frictionless for the consumer to borrow money. It's making it mathematically safer for the company to lend it, because they have a complete 360-degree view of that user's financial life.
It's the ultimate informational advantage in modern fintech. And they fully intend to leverage that advantage to drive meaningful, compounding variable profit as these user cohorts mature year after year.
So we've thoroughly analyzed the seller ecosystem with the Square merchants using ManagerBot's 100 micro agents to run their shops.
Right.
And we've dissected the consumer ecosystem with Cash App users managing their money and utilizing Borrow.
The final massive piece of this puzzle from the source material is how they're finally smashing these two gigantic networks together.
This has been the overarching strategic ambition of the company for years. I mean, they have these two massive, distinct user bases, and they are finally executing the collision through a program called Neighborhoods.
Neighborhoods directly connects Cash App buyers to local Square sellers.
Yeah. And the stats from the Q&A show this is hitting a huge inflection point. In April alone, they added more sellers to the Neighborhoods program than in the entire previous history of the feature combined.
That's incredible.
It now represents over $320 million in annualized GPV.
And the cross-pollination metrics they shared are staggering. On average, a seller who joins the Neighborhoods program gets about 1,000 Cash App followers in their very first year.
Wow.
But the crucial detail is this. About 50% of those new followers weren't even active on Cash App the month prior to signing up for Neighborhoods.
Let's just pause on that stat because it's massive.
It really is.
That means the local coffee shop or food truck is actually reactivating dormant users or driving entirely new user acquisition for the tech company just by utilizing the platform.
Exactly.
A local merchant offering a discount is a significantly cheaper and more effective customer acquisition channel than running expensive digital ads.
And it pays massive dividends for the merchant, too. Spend at a seller from their Cash App followers eventually reaches about 10% of their overall sales volume after just a few quarters.
That's a solid boost.
But the most powerful tool in this entire program, the thing that really glues the buyer and seller together, is the direct messaging feature.
This is where we see the scale of what they've built. This is the holy grail they've been chasing.
Yeah.
It's like turning every local business into a mini Amazon Prime ecosystem. Instead of a small business owner screaming into the void of a chaotic email inbox where open rates are terrible, they are pinging their customers directly inside a financial app.
Right.
They are placing a highly targeted, localized offer inside the exact place where the customer's money already lives.
And because both the buyer and seller are on the same network, the friction to purchase is effectively zero.
Zero friction.
The payment method is already authenticated, the identity is verified, the transaction is instant.
Which explains the conversion numbers. The executives explicitly stated that the conversion rates from sellers messaging their followers inside the app are 6 times higher than traditional marketing emails.
6 times.
A 6x conversion rate is practically unheard of in modern digital marketing. It fundamentally alters the unit economics of customer retention for a small business.
And leadership recognizes this isn't just a win for the local sellers, it's a massive network density driver for the consumer app itself.
Right.
They stated in the Q&A that they expect Neighborhoods to meaningfully drive Cash App active user growth in the back half of the year. By connecting the two sides of the counter, they create a self-sustaining flywheel.
Walk us through the mechanics of that flywheel.
Sure. So the more sellers offer localized, targeted perks through the app, the more consumers are incentivized to download it or reactivate their dormant accounts to get those perks.
Makes sense.
That influx of consumer activity gives the AI models more behavioral data. Better data allows the underwriting models to offer safer, larger lending products via Borrow.
I see.
And when the consumer has more purchasing power, they inevitably spend a portion of it back at the local Square seller who brought them into the ecosystem in the first place.
It's an entirely closed, self-reinforcing loop. So bringing this all together for you, the learner, the source material we dove into today paints a picture of a company that is no longer satisfied just processing credit card payments or facilitating peer-to-peer transfers.
Not at all.
By radically flattening their corporate teams to increase their engineering velocity, utilizing agentic AI like Goose to completely automate the boilerplate code, refining their dynamic underwriting models to safely scale unsecured lending, and directly connecting their massive buyer and seller networks.
Yeah.
They're building an interconnected, proactive financial intelligence web. They're literally trying to replace the dashboard of your financial life.
But that ambition raises a deeply important question. We are moving toward a reality where an AI can accurately predict your personal cash flow deficit before you even realize you're going to be short on rent. And simultaneously, auto purchase inventory for your local favorite coffee shop without the owner lifting a single finger.
Which is wild.
We have to ask, where exactly is the line between a helpful financial tool and an autonomous financial vehicle that completely runs our lives?
Yeah, that's the big question.
As these platforms shift from merely giving us a dashboard of data to making the actual decisions for us, how much of our financial autonomy are we going to willingly trade for the sake of extreme convenience?
It's a profound thought to leave you with. I mean, when the medical x-ray machine doesn't just show you the broken bone, but automatically schedules the surgery, orders the cast, and deducts the copay before you even leave the emergency room, you really have to wonder who is driving the car.
Absolutely.
Thank you so much for taking this custom-tailored deep dive with us today. Keep learning, keep questioning, and we'll see you next time.